Hello, hello. All right, we're going to go over assignment 3, which I think is the most forgiving of the assignments. Let me pull it up. Oh, there we go. Let me pull it up. So assignment 3 consists of depreciation, working capital, and CapEx and debt. So I think this one is probably the most straightforward of all the tabs. It's due Sunday, November 5th. So there it is. Okay, so we'll start. So it's depreciation, working capital, and CapEx. So let me make sure, let me position the mic so you guys can hear me better. Okay. All right. So it's these 4 tabs. Let me highlight them and just go through them. So depreciation is accounting. It's an accounting convention. It's the value of an asset declines based on use, and there's all these accounting rules around how to. So you kind of start with your plant and equipment. So land is not included in it because land does not depreciate. So, and then there's special accounting laws where you could depreciate interest during construction and financing fees. So included in your initial depreciable basis will be PP&E, plant and equipment, interest during construction, underwriting fees, annual commitment fee, and all these link to the construction tab. So the sums of your construction tabs over here. So this is what we depreciate, and we call this straight line depreciation. So the same amount gets depreciated every period for 30 years. So that's 60 periods. So it's this total amount divided by 60. And then just so each period, and it doesn't increase with inflation. It's all nominal, or all real number, I mean. And just so each period, it's that amount. And it's just an account that depreciates all the way through. And then this depreciation will reduces your taxable income. So EBITDA, earnings before interest, tax, amortization, and depreciation, or depreciation and amortization, this lowers your taxable income. Okay, and then we just have different accounts. So you have your depreciable basis for this account, and it's just your plant, property, and equipment, and your financing fees. And then your CapEx also depreciates. So anything you invest is like an investable asset, you could depreciate. So all our CapEx spend qualifies for depreciation. So even like if you buy a car, you could depreciate a car because it's an investable asset. And so the same thing with this one, it comes up from your CapEx tab. So we'll see where it links from CapEx. So there's multiple CapEx events. And then each one of these CapEx events ends up as an account in your depreciation, I guess, like book. So whenever this comes online, it starts to depreciate, and it depreciates at a different rate. So your CapEx, so this is like if you install like a new Windows and new equipment onto the plant, you're able to depreciate that new asset. And then so it's just over 5 years, 10 periods, straight line, so 10% per period. And then whenever it comes online, you have a CapEx trigger with a counter, and then it triggers and you just pull it directly from the CapEx tab. And then you start to depreciate it each period. And then you just do it again and again for the other accounts. So the other CapEx events. So each one is a discrete like account. So you have like 4 CapEx accounts plus the initial depreciable basis, and this forms your total CapEx. So this kind of builds up to your PP&E beginning of period, your total depreciation, and then your PP&E end of period. So you're depreciating your plant, property, and equipment by the amount listed above. and then the value of it goes down. So it'll be really interesting. You'll see in the later class how depreciation as it goes through. So on your assets have to equal your liabilities and equity on the balance sheet. So it's really interesting to see how on your income statement how depreciation flows through that. Then you end up getting this net income number, which becomes the start of your cash flow statement, and then ends with your cash ending balance, which then ends up on the asset side. So there's this whole dance that depreciation flows through all three statements, and it'll be really interesting to see that at the end of class when you go through the three statements. And it's a very common job interview question. So that's CapEx. It's pretty straightforward. I can answer any questions via email. Working capital is just the amount of cash in the cash register that the business needs to maintain operations. So you generally base it off the number of days. So your accounts receivable, we call these days sales outstanding, DSOs. And then your APs, which are your accounts payable. And so it's very important in the business world that your DSOs, your accounts receivable days, are in line, because this is cash that your company has not received. And accounts payable is the reverse. It's cash that you owe that you haven't paid yet. So you want to see your accounts receivable low, and you want to see your accounts payable higher, because that means you have more cash on hand. So accounts receivable is money you haven't received yet, and accounts payable is money you haven't paid yet. So accounts payable would be like a bill. Like if you haven't paid your rent, say your rent's like 10 days overdue, then that's kind of your accounts receivable. And they kind of prorate it for the amount of days. So about amount of days outstanding. So it's 60 days in a period, or 60 days is kind of our average, I guess, collection period. So when we get paid, it takes 60 days from when we bill to when we get the money. And then accounts payable is we usually get payment terms. So we usually when the bill comes in, we have 45 days to pay it. So that's kind of how it works. So then you end up calculating it. So you get your operating revenue, and then your accounts receivable is you prorate the operating revenue for the period. So it's half, or sorry, you prorate the you take your accounts or your DSOs, your days receivable, then you prorate that for the time period. So you divide it by 365 divided by, or 365 times the prorated semester. So really this period isn't 365. So your days receivable are based on a full year. So you have to scale it down. It's like the same thing with interest. This is like an annual number. You have to de-annualize it. So you're de-annualizing it, and then you're timesing it by your operating revenue. And then this is how you get your accounts receivable. And it's the same method for your accounts payable. So you get your operating expense, and then you do the same method. You take your days payable, which is based on a full year, and you prorate it, you de-annualize it for the semester for half a year, and then you times that by your operating expenses, which is 6 months. So generally in the real world, you get accounts payable, and you have to back into days receivable and days payable. And then that's your total working capital. Is this the difference? So you take so this number is the amount of cash you need on hand to fund this accounts receivable amount. So it's a net number. So your accounts receivable is money that you've recognized as revenue, but you haven't physically received in cash. And then accounts payable is an expense you've recognized, but you haven't received in cash. So there's going to be a cash shortfall and like actual cash, like liquidity in your bank account, with the difference between accounts receivable and accounts payable. So that's kind of what working capital is. It's the amount in the cash register you need to keep the business going. So that difference, so you could kind of tell that 12 million of the accounts payable is money that you've already booked as expense, like you already counted as money out the door, but maybe this is all like during the week type of stuff where it's like maybe you get paid on Friday, but you have this bill due on Monday, and there's this timing gap. That's kind of what working capital is. So you could kind of say your accounts payable, this is $12 million that you owe that you haven't paid yet. And then your accounts receivable is 26 million that owes to you, but you haven't received. So to fund that, so how much cash you need in the cash register is really just the difference between those two numbers. So you need $14 million to float yourself. So the example is, say you have a bill Monday, that's $10, but then you don't get paid until Friday, which is $20. That net difference is so that $20 would be your accounts receivable, and that $10 would be your accounts payable. And so you would need $10 in cash to kind of float yourself until you get paid. So you owe that bill Monday, then you need to pay that, and then you don't get paid till Friday. So that's kind of like your accounts receipt, your working capital. And so your initial working capital is just this first amount. And this flows back to the construction. So you got to put money in that cash register up front before you could really start business. And then really, we already invested all that money in, and now all we're really worried about is the change in working capital. So they call this net working capital, change in net working capital. And it's weird. So when this number is negative, when this number is negative, that means there's money coming out of the that's money coming out of the this is a source of cash, this is a use of cash. So each year or each semester, you have to put $88 or whatever amount of money back into, you have to invest it into working capital to fund that cash shortfall. But then this is a maintenance period. So there's just less bills in this period, or I guess less revenue. So you have less cash. So you could take money out of working capital and use it as rather than a use of cash. So this period, you just have less of that cash shortfall. And so you could take $4.5 million out of working capital and realize it as cash. But then the next year, you're back up to this higher revenue world. And so you have to put $5 million back in to plug that cash shortfall. So that's why these numbers are kind of swing around. So you really want to see, most companies that are growing have positive working capital needs. So that means you have to invest more money into working capital. So when you see this on the income statement or the cash flow statement, it's usually a negative number. That means there's cash coming out of revenues and into working capital. And then here it's positive because you need more money into working capital. So you can see those numbers increasing. So generally, growing businesses have working capital needs that are increasing, especially businesses that are growing really fast. So this is kind of an underrated thing when people invest in companies, is that when you get to free cash, like liquidity, like a credit risk, you're going to see that working capital needs are very high. It's almost like CapEx, and it's hidden. Like this is something you have to kind of research, and there's accounting companies that come in and research working capital. So the concept working capital is very confusing. And there's people whose literally their whole jobs is to go in. Even people who are auditors don't really audit working capital that deeply. There's even specialists in the accounting field of working capital so if there's a company that really has strange working capital, you hire specialists. So this is a very difficult concept. And then CapEx, you gotta inflate it. So each period increases. There we go. So the CapEx needs, each event happens every X amount of times. So I think it's every 10 periods, 10 or 11 periods, there's a CapEx event. So every event you have a flag. Yeah. So it comes from time and technical, and that's your CapEx event. That's your maintenance. Or no, sorry, I think there's a CapEx flag. So you just take that CapEx flag in your timing and technical, and then every time there's a CapEx flag, that's when there's a CapEx event that you have to pay CapEx or you have to invest in CapEx. And then there's a counter. So here's the flag, and then just counts every event. And then here's your CapEx real number your 2017 dollars. And then you just have to inflate that with the inflation escalator. And then so there's a very interesting code for how to do this, and we'll see if you guys can figure it out, because it's a very specific. It's kind of an interesting way to do Excel. That's to get this counter right, because it's more difficult than it looks. So CapEx is pretty straightforward. Whenever there's a flag, you owe CapEx and then just inflate it. And that's it. And the only difficult thing is trying to get this code right. And then debt profile, this is probably the more complicated of the four. So this is kind of like our amortization schedule. So you guys can kind of take the same debt service tab and you do it with your student loans as well. So it's mortgage style. So mortgage style just means that you pay the same amount every period. So you notice that. And then so you have your operation flag, debt amortization flag. And then so our interest is 8.5 and it pays over 25 semesters. This is our total debt amount. So you start with beginning of period debt, or end of period here, then beginning of period, then you owe your principal payment. So we use a special function called PPMT, which is, it's kind of like your financial calculator, like your PMT function on your calculator. So you kind of just, you guys can go online and figure out how to use the exact function, but you kind of take your periodic interest and whatever period you're in, and then the number of semesters and the total value. And this is your, so you can see it, your rate, period, or your rate, and then your period you're in. This one's total periods, and then present value, which is the loan, and then future value is 0. That means it's paid off, and then type is 0, and then you get this periodic payment. So it's just like a financial calculator. So you could see that, like in period 10. And a 25 period amortization with that interest rate, with that beginning value, and 0 is the end value. How much do I owe that period to pay it off in 25 periods? And that's exactly what it is right here. And then so you do your debt outstanding minus this amount, which is your principal. Then you get your debt outstanding in the period. And so this is your amortization. And it's kind of like separate from your interest. So interest is a separate payment you owe on outstanding debt. And then your and that's kind of driven by your amortization. And then your amortization is just how much is your schedule. It's 25 periods mortgage style. So mortgage style just means your debt service is the same, and your debt service is just your interest plus amortization. So then we look at interest. All your interest is you use IPMT, which is just like the I \y function on your financial calculator. So it's the same concept as your PPMT function. So you take the rate, which is 4.25. Then you take the period you're in. Then you take the total periods. And then your present value, which is your debt outstanding. And then your future value is 0. It means it's paid off. And then type 0. And then you get your calculated interest. So with these two together, with these two functions together, it calculates your debt service. So like if you would have done this on the financial calculator, you would have done N, which would be 25 periods, present value 0, future or present value this amount, future value 0, I \y would be 425 because you're deannualizing this, and then you click calculate PMT, and then you get this number, and then so that's your payments you owe every period, and then with that IPMT and then PPMT functions, then you figure out the breakout between principal payment and then debt interest. That's what it does. And this all flows into very specific places later in the model. And then here is your average loan life duration. So really your exposure on the loan, it's a $332 million loan, but your exposure isn't 25 semesters because you pay off a portion of it every period. So you de-risk your position. That's what they call it. So it's you have an outstanding exposure. People call a position, and then you're de-risking that position by paying it off by receiving payment on every year. So every year, every semester, you on day one you have $332 million exposed to the market or to the counterparty risk or whatever, but then they pay 7 million, then 8 million, then 8.4 million every period. So each period, that amount exposed goes down. And then eventually they pay it off over 25 semesters. So really, you kind of prorate your exposed amount over the course of time. So it's kind of what you're doing here. This is your amortization years. So it's 12.5, and you kind of break it out. You kind of build it up like half a year, 1 year, 1.5. And then this is your amortization amount, like what percentage of principal has been paid. And that's just the amount of that period's amortization divided by the total amount. So you pay 2.3, and then eventually you're paying 6.3% of the loan there. And then this number, you just times it. You times it by year outstanding times the amount of principal. And then you just sum the whole thing, and then this is how you get your average loan life. So really all you're doing is you're almost discounting the value. You're almost discounting your amortization payments by the amount of years outstanding. So you're giving more year. So you're just figuring out how much principal. You're weighting the older principal payments higher than the earlier ones because those are more risky. So that's why you're taking 12.5 years outstanding times whatever percentage comes out there, and you get this higher number because this is a higher risk, and then you sum it up. It's almost like a net present value, but the inverse. It's like a net present value of debt outstanding. So it's like a net present value of risk, of outstanding risk. And then so you end up, so really the like technical term is that a $332 million loan with that amortizes based on this schedule over 25 semesters is equivalent to a zero interest loan that pays that it's a bullet payment. Like you don't pay any principal. The full amount is at risk. And so the equivalent is to a 7.56 zero interest loan. So a 25 semester, so a 12.5 year loan that gets paid off each period with this specific schedule is equivalent to the same risk as if you took out a loan and didn't pay it until the very last day of 7.56 years. So this is kind of a way to measure risk across different products. So this is very common for bonds, for other stuff, like other loans. So it's a way it's like a risk metric across different styles of risk. It like normalizes it. So that's kind of what average loan life means. And then that's it. That's it. Let me know if you guys have questions. I'll have another TA session on Sunday. Available through email. I'm available. Yeah, feel free to email me. There's answers on the website. This one is definitely the most straightforward of the 4 tabs. And then after this one, it's going to get a lot harder, guys. Like and more from the accounting perspective. And accounting is kind of a pain in the ass to get through. So it gets more technical. So you could expect more TA sessions, like higher touch from me, that I can kind of get you guys to do the more technical part of the class, which is upcoming. So thank you guys, and reach out whenever you want. Expect another TA session on Sunday, and I am available through email, and I respond pretty quickly. All right. Thanks a lot.